Welcome. I'm David Phillips, the CEO of Estate Planning Specialist, and I'm so excited to be here today to share with you what I think is going to be a revelation for a lot of you. I have just received today in my email blast a notification from one of the top annuity carriers in the United States that they're having a significant rate increase. And I'm scratching my head trying to figure out what is going on, because we've kind of been at a level playing field for a long time, and all of a sudden things are starting to heat up, and I mean heat up. And so I've asked the president of our company, Todd Phillips, my son, to share with you today what's going on in the world of annuities and why in the heck are things heating up so much and why you need to make a move now. Todd?
All right, thanks, Dad. Yeah, it's interesting how it's correlated to the time of year. I mean, here we are, we're just starting to hit 100-degree temperatures, and it's kind of exactly what's happening with annuities. They are heating up. And we also are facing a lot of financial storms right now. It's kind of everything is converging together to, I don't want to say perfect storm, but it's starting there. We're starting to see signs of stagflation. Recent polls, 81% of Americans believe that we're already in a recession or that we'll hit one in 2022. That's 81%. The S&P is already down 11% this year. So it's, I mean, we had fantastic returns, but now we're finally starting to go back down. Who knows if it's going to rebound up. We're 30 trillion in debt. That's 91,000 in debt per American. That's counting children. So it's a substantial amount of debt. Our GDP is now, it's 100% of debt to GDP, which is significant. That's a milestone that we haven't crossed. Inflation, regular general inflation is up 8.5%. Energy costs are up 32%. And we've been to the pump, 40-year high that we've hit. We have supply chain issues. I'm trying to buy a truck, and if anyone's shopping for used cars, you'll know that I couldn't believe it, but the used cars are going for more than the new cars. I was looking at a Tacoma, it was $45,000 for a used. The same one was $40,000 new. The problem is you can't get the new one. You got to wait 2 to 3 months just to get it. Hope you get it, and something doesn't happen with the processing. So we got some major supply chain issues. Obviously going into war, or the war is starting out in Ukraine with Russia. So there's a lot of calamity right now. It's a difficult time.
Mom came running into the office today and told everybody we're in a recession, because she'd been listening to Fox, I think, right? So,
yeah. So it's interesting times right now, and a lot of people are.
And that's why I'm kind of confused. Well, why are annuities?
Well, yeah, the annuities. We're going to get to that here. So it's interesting. I just went to a big seminar, and they were talking about where the money is flowing, and most of the money is actually going into banks. So people are they don't know where to go to the stocks, they don't know, so they're going to CDs. In fact, just in Arizona, you can go to this website, and this FDIC website, and it'll show you where the money's going. Pre-COVID, there was 141 million into CDs. Since COVID, it's now 203 million. So that's a 44% increase into CDs just this last year. Now,
and CDs are still paying?
CDs are still,
nothing?
I looked up Bank of America was 0.03%, Chase 0.01%, Wells Fargo 0.01%. Now there are some CDs you can go online that you can get maybe 1-2%, but if you want to just go to your typical
But you're tying your money up for a long time.
Tying your money up, and that's a 5-year CD. So not a terrible play if compared to losing 11%. But yeah, so a lot of people are sitting on the sidelines. Unfortunately, like we said with the inflation, their purchasing power is going down 10, 20, 30%. Who knows where inflation is going to take us. So that's kind of sticky or tricky if you're going to just sit on the sideline or put your money in a mattress. That's not going to really keep up with inflation. Real estate here, as you know, is through the roof. It's up 40% since last year. So I mean, it's If you already have assets, great, and then hopefully it'll keep growing and keep those. But yeah, it's kind of, investors are scratching their heads where to go. Let's talk about bonds, because a lot of people are, the old rule of thumb is to go to bonds and stocks. And bonds right now, with interest rates rising, have had a huge hit. As you know, when interest rates rise, bond valuations decline. The Bloomberg Barclays U.S. Aggregate Bond Index, which is an index people use to track bonds.
How many B's is that?
That's a tough one. That index is down 10% from its peak in August. So just if you had a bond index, that's down 10%. So just owning bonds is you've lost value. I have this clip here. We'll show it on the slide. But the U.S. bond market wipes out over $2 trillion, marking the largest loss in recent history. In bonds, $2 trillion just recently. So bonds are taking the shorts right now, and if rates keep rising, they're going to continue to lose. And I mean, the good news is new bonds are having higher rates, but the older bonds are tough. And if we keep having rising rates, then those bonds will continue to decline. And then we have stocks. And as you know, a lot of people are henny penny saying the sky is falling. But it's interesting, as I was looking it up, the S&P, like I said, is already down 11%. Bitcoin's nearly been cut in half since its peak. But yet there's some positive signs too that could still show growth. The unemployment is still all-time low, 3.6%. So there's still people who are having jobs and they're still working. And I was just reading this on Friday, CNN had a big article that we should expect a melt up, meaning the market's going to skyrocket up before the next crash. So there's a lot of pundits, people that still say that we could see a good run up. So I don't know what to do. Are we going to continue to crash, or is it going to bounce back up? I'm going to miss. There's just a lot of things to consider.
So is that why everybody's on
I think that is
the sideline?
I think they're just sitting on the sidelines and wait until they figure out what's going on. But yeah, definitely a lot is going to the sidelines. I have this graph here of just the S&P since 2000, and we had an incredible run up. We really did until really January of this year, and then it started to drop. But it's been a pretty amazing run up to this point. So I want to talk about an idea or strategy that you already mentioned, but that I've focused on since I've been working in 1995. I kind of grew up with annuities. I know you were on the board of directors of one of the first, to create the first indexed annuity back in 1995, and that's when I started working with our company. And so yeah, I've had a lot of time. We've helped.
And may I interject? You also wrote a book.
I wrote a book. Yep.
Indexed annuities. I have it right here.
Yeah, wrote it a couple iterations of it. I've also been the annuity advisor for Mark Skousen. He and his family have bought lots of annuities from us. Bob Carlson, Stansberry, David Eifrig, Tony Sagami. Yeah, Porter Stansberry. So yeah, it's been a long time. It's been 24, 25 years of working on these, and anyway, now's a really nice time because rates are finally to where they're getting exciting again. They were okay before, but now we're seeing a lot better rates to where my indicators are saying this is a good idea. So I'm getting into that. First, we're going to talk about annuities and that they are the safe harbor in this storm that's coming. Higher interest rates means we're going to get, the insurance companies are able to buy bonds that are getting higher rates, and they also, the options of volatility, well, I'll get into it, but rates are getting better, and that is because of the higher overall market interest rates. And that means more growth for you, more interest, better inflation hedge. So all good things. We want higher rates. Now, when it comes to annuities, there are a lot of different types that we could write a really thick book about them. I'm going to briefly go over each one, but understand, audience, that we can spend a lot of time on each one. I could spend a whole hour on each individual one and compare. But you were the water ski coach for ASU water ski team.
For 12 years.
12 years.
And we won the national, we won the
nationals.
Can you see this?
Yeah,
Won
I
the
was
national
I was an All-American.
Yeah.
We spent a lot of time on the water, and something to know about water skiing is, hey, let's go water skiing. Well, what event do you want to do? And there's 3, 4, 5 events if you count wake surfing, but we've got slalom, trick, and jump, and wakeboarding, and each one has its own unique tool, and that's kind of how it is with annuities. You got slalom. You certainly don't want to go over the jump rep on a slalom ski, or a trick ski, and you don't want to try to do tricks on a jump ski or slalom. I mean, each one has its own tool for the trade, and that's the same with annuities. And I'm going to get into each one, but some of them try to be like an all mountain type ski or all water ski that does everything, but usually, in most cases, it's important for our clients or audience to call in and help explain to me what you're trying to do, and then I can tell you what tools to use, because there's a lot, and luckily I have the background to know which is the correct tool for the trade. But I'm going to go over just kind of the general types. So the first type, I'm going to start with maybe simplicity and then get up to a little more complicated. The first type would be a MYGA, or multi-year guarantee, and that's going to work like a CD. Exactly. So it's just the only difference between that and a CD really is that the interest grows tax deferred, whereas CDs you pay tax on an annual basis on the gain. Next we're going to talk about is single premium immediate annuities. They also call SPIAs. And then a same version of that, but a delayed or deferred version of that, where we wait to start the income maybe 5, 10 years out. Those are called DIAs. Also, those are QLACs. And then we're going to get into fixed indexed annuities, which is what I wrote the book on. So that's probably where I know the most about. Those come in all shapes and forms with different riders, income, death, long-term care. And then we've got registered index-linked annuities, which is same as a fixed index annuity, except you're going to have a buffer on the downside. You get a little more upside, but you have that buffer. And then we have variable annuities, and they also have income riders to go with the variable annuities. And then last but not least is the long-term care annuities. And that's we've spent a lot of time on those. A lot of clients, I know Bob Carlson's recommended, Mark has as well. Even David Eifrig, they've all talked about these long-term care annuities, really popular, really great. At this time, those are really great, gaining a lot of traction since they came out in 2010 when we first started offering them. So let's start off with the MYGA. So like I said, that is the simplest form, and it's going to be like a CD. Neat thing about MYGAs is they're issued up to age 100. So for our older clients, they can get them all the way clear up to age 100. Rates are a lot higher than they've been. It's pretty common that we can find 3.6% for 5 years. So better than CDs. I think the top CD I could find was 2%. MYGAs are 3.6. So you usually get about 1 to 1.5% more on a MYGA. It is guaranteed by the insurance company and also your state. So we can talk about that. There's some nice guarantees. Interest grows tax deferred instead of, like we talked about, CDs where you're taxed annually. So it's going to grow a little bit faster because of that deferral you're not paying. So I have an example here. MYGAs typically go from 3 to 10 years. And super easy to get a quote or find out what's the best MYGA. Very easy. So if you want to learn about MYGA,
you kind of have to watch out for the strength of the carrier, though, don't you, on the MYGA? Because I've seen some MYGAs that have the company is a little questionable, and in my opinion anyway, and the rates are a little higher. They're kind of like a come on, and so. I think that's a concern.
Yeah, I mean, don't get one that's C rated, but we're not going to recommend any that's not at least B++. We've got some great ones right now that are A+ or A rated because there's
no reason to go
right. I think when you're getting a MYGA, the key is just understanding the withdrawal features, because some of them will say absolutely no withdrawals for the whole duration of the MYGA. You can't touch it. Some will say interest only. Some will say we'll give you 10% free withdrawal, and some they won't even. They'll charge you a surrender penalty for death. If you were to die, you pass it to your spouse, she could have to pay a surrender charge. So be careful of that. I like the ones that are a lot more liquid and that they'll give you the 10% free withdrawal. and waive any death or surrender charges. But yeah, I have an example here of just comparing the value of a MYGA that's versus a CD that's, or a similar investment that you are paying 28% tax on. Over the 5 years, the MYGA would have grown to 119,000, whereas the CD would be 113,000. So just that tax deferral does make a difference over time. Here's some quotes right now of some of the MYGAs that are available. This changes weekly. This market changes a lot. So yeah, like I showed you, the Fidelity and Guarantee, great one, but it's interest only. Whereas the Americo and the Sagicor, they allow 10% free withdrawal. This is an example of 5-year MYGAs. We have 3 all the way to 10 years to choose from. All right, now we're going to move on to SPIAs. So when people talk about an annuity, when you learn about it in math class or the general sense of what is an annuity, you're giving somebody money and then they're giving you payments in return. That's what the traditional sense is. MYGA would be a deferred annuity. You're letting it just continue to defer. You're not turning on an income stream, just letting it grow and then you take it out like a CD. But the traditional annuity that goes back 300 years would be a SPIA, immediate annuity.
I also like to refer to it as, and I know that the I is immediate, but I also like to use the I as income because it's a little easier to understand. Single premium income annuity. You're getting income for it.
Definitely designed for income. That is the purpose. It's to create your own private pension. It's a longevity bet. So if you're not healthy and you think you're going to live to 80, you don't want to get a life-only SPIA. Right. But if you got longevity in your blood, you're living to 100, then yeah, SPIA might be a great play. And you can make some more of a financial bet if you aren't so worried about it leaving to beneficiaries or to heirs. The single premium immediate annuity is going to be the highest payout of any guaranteed income option. Right. So, but because you are betting your mortality you're putting your longevity on the line, and it's a bet with the insurance company. Now, before I get into SPIAs, I want to talk about the internal rate of return calculation. We use internal rate of return to calculate the benefits of a life insurance policy. It measures the cash flow with the time value of money. So it takes the compounded annualized rate of those cash flows, and it allows us to compare any investment apples to apples. We could take rental and real estate. You buy a VRBO, you got your own, and you can see, and you sell it later, sell the house. All of those can be compared with the internal rate of return. It's a really important calculation, and go ahead and show that. And allows us to have parity and compare pretty much any investment to itself. And so when we look at SPIAs, we need to look at what is our rate of return on investment. And so I have an IRR here at 85 and 95. So let's just look at a 65-year-old. So a 65-year-old that has $1 million could get a SPIA and be guaranteed $64,366 for the rest of his life. Now that's life only. So if he gets that and dies the next day, the company keeps the money. He could do the same if you look at the chart below. He could get the return of premium option. There's lots of different options you can get with SPIAs, 10 years certain, 20 years certain, but return of premium, if he dies, then he can have a beneficiary that will then get the remainder of that $1 million. So his family is not out the money. But maybe you're single, maybe you don't have a need to go to some beneficiaries, then you could just get the life only, and they're gonna make you sign a waiver saying, I know it's life only, but you can definitely get that, and you will get a higher payout because you're making that bet. And look at this guy here, if he puts in $1 million, if he lives to 95, he's almost collected $2 million. And his rate of return, his internal rate of return.
That was so the income would be 61,000, almost 62,000 versus 64 life only, and he has a return premium on there.
Right.
So yeah, that's a much better deal.
Yeah, I mean, but if you don't care about, I've had a lot of clients that they don't have any beneficiaries. It's life only. Let's do it.
Give it to me.
Yeah, I think I'm going to live a long time, and I'm going to take that bet. And maybe it isn't that significant. So do you have a lot of choice when it comes to that? Let's look at the rate of return though. So if he lives to 85, 65, lives to 85, and he's collected $64,366, his average return on that money was 3.25%. So what that means is if he had another investment, that average 3.25, he'd end up at the same, be the same. And if he lives to 95, then it's an even better rate of return, 5.5%. And then obviously, if you're older, you're going to get a higher payout because you have less life to live. Just like with your Social Security, if you defer taking Social Security, you're going to get more. If you defer and start a SPIA later, you're going to get more. So that is the SPIA. Now you can get those as a single, you can get it as a joint, and then we can add all these different guarantees. But the life only is going to be the highest payout that you can get. Let's talk about the deferred income annuity. So this is the exact same thing as a SPIA, except we're just going to wait. So we're going to buy it today. We're going to give them $1 million today, but we're going to wait 5 years, 10 years. You can vary it however you'd like. This also is referred to as a QLAC, Qualified Longevity Annuity contract. And that you can use that as a substitute for money that you would be having to take from RMDs. So that has to be qualified money, IRA money, and you're limited. I think it's $135,000 now. So you're limited to how much you can do. If you're big dollars, it's not going to work, but the QLAC is there, is an option, and I'd be happy to talk to clients about that. But this is a
kind of a buzzword though, is the QLAC, and it really is just the deferred income.
It is. It's a delayed
deferred immediate annuity or deferred income annuity.
Yeah. As you can see, so I'm starting later. My 65-year-old, he's now getting $87,000 if he waits 5 years. So he gets quite a bit more than the $64,000.
Same idea with Social Security though.
Yeah, he's getting more, but he's waiting longer. But notice his IRR is about the same, and that's why I think it's so important. Some people just see that number and they go, "Oh my goodness, I'm getting $87,000 now. If I wait 5 years, and I'm only getting 64." But you got to understand the time value of money. You were getting that money those other years, so that's why the IRR is so valuable, because it's going to show the actual return on investment that you're getting, and it kind of sets it into perspective.
And all of your illustrations show the IRR then, or?
It doesn't come automatic. I have to run it.
Yeah, I see.
But I definitely.
But it's important.
So it is important, and I'm hoping that maybe someday there will be some software that's out that will show that, and just full disclosure what the actual return is on investment. But notice the IRR at 85 for our single male that is waiting is now 2.84%. Our IRR before was 3.25 when we were taking it right away.
Okay, now let me ask. This is kind of the key. So you said to go into a safe harbor is kind of what you want to do. That's what we're talking about, putting this money in to get it out of the storm and everything like that. Put it on the sideline or whatever, or get it out of the storm. Safe money, safe harbor. Is the deferred annuity or the QLAC, is that considered a safe money?
Well, it is.
I mean, is it guaranteed? Are there any way that this cannot be paid out?
Well, I mean, if all the insurance companies go under and the entire reserve fund collapses and all the states in Armageddon, yeah. But provided that
what you see is what you get.
Right. There's not a lot of there's no moving part to it.
Okay, that's kind of what I want.
The trade-off with the SPIA again is that you lose control. Just like a pension, you can't go to your employer and once you've triggered your life only or your pension and say, "Hey, I want upfront money." I mean, there's other maybe side markets you could probably get for that, but you can't. You lose liquidity once you commit to a SPIA. So that's the one drawback. It is a big commitment. Once you jump in, you're in.
But a lot of people want income.
It's very attractive just to know that, hey, I've solved this part of my retirement.
Yep.
I got this gap. I need $20,000.
I mean, the number one concern that I hear, besides, there's the long-term care part of it, but one of the number one concerns, or one of the top concerns, I mean, is running out of money. And
Right.
this kind of solves that problem.
It does solve it, absolutely does.
Yeah.
And if you want simplicity, there's nothing better. It's just, I know exactly what I'm getting. I guess the one issue is that the biggest issue is inflation, because if I commit to my $60,000 a year, in 30 years I'm still getting $60,000 a year, and who knows if we're a banana republic and we don't have those dollars, what is that going to buy me? So you need to have other assets at play that are keeping pace with inflation. But this is definitely for the
some of your money in.
deflation area, just to lock in and know that you've got that covered. People take pensions, people take Social Security is a...
And I was talking with a client today, in fact, and he was talking about doing a Roth conversion and then doing a deferred annuity, a DIA, because you didn't need the money right now. But, and I said, well, yeah, with your Roth, swing for the fences. Because any gain that you get is going to be tax-free forever.
Right.
Unless they change the rules. But tax-free forever, current rules, okay? And then he has the money over in the safe harbor over here in the DIA.
Right.
And, so I like that combination, do some in Roth, do some, if you're going to take any risk at all in your investment portfolio, really put the risk over in your Roth.
Yeah, that's your moonshot money. Yeah, and definitely we like, I don't typically recommend Roth for this. Some clients are just more conservative and they want that. And there are some growth annuities that we're going to get into, a little more growth potential, but typically annuities are the safe money. And generally speaking is why you're doing that too. Yeah. So a lot of times we see a lot of IRA money for that. Let's go on to the next annuity, and that's going to be indexed annuities. This is my favorite type. This is where we really came out and we talked about, wrote a book about it in 2003 and then made a couple different editions, and now I have to rewrite it again because the last one I did was in 2014.
You do have to rewrite it. We've been nagging at you for a long time.
Yes, it's definitely due. There's now, it's completely different than 2014 even. They've evolved with all these different indices. There's over 40 different indexes now that these insurance companies use. So it's no longer just the S&P, the Dow, and the NASDAQ.
Well, the nice thing about the indexed annuity, I'll just interject before you start to explain it, is that most people do understand what it is now. When you came out with your book, your first book, nobody knew what it was.
Yeah, I think most people understand the basic form of it, the naked form of just indexed annuity, where you get some growth if the index does well, and if it doesn't, you sit on the sidelines. I think they get that. Where we get confused is the radio ads, which we're going to get into, and the big bonuses and the income riders. That's really made it confusing, in my opinion. And I talk to clients, and they bought an annuity from somebody else, and it's now 10 years later, and they're saying, I can't take my money out. What's going on here? Explain to me what I have, or they'll argue with me and tell me that their annuity is guaranteed to pay them 10% or 15% a year, and I have to dispel that myth and explain. So we'll get into that in a minute here.
Can we talk about what a fiduciary is too? I want to kind of not right now, but eventually.
Sure.
Okay,
good. Yeah, the bottom line of the basic indexed annuity is going to have interest that is linked to an index. And if the index does well, you make good money. If it does poorly, you get zero. Some have a 1% guarantee, but usually it's a 0. And so you sit safely on the sidelines if it's down. So right now it'd be a great idea for index annuities. We have some amazing index annuities, which I'll get into in a second, that I've had clients make over 30% in a good year with index annuities. Now that's rare. They're designed to be more like 4 to 7%, typically 1 to 2% more than the MYGAs, because you're taking a little bit of risk. You could get a 0, whereas the MYGAs are absolutely guaranteed. But I'd say on average we're about 7% is probably a good expectation. They did well, fantastic. 1995 to 2005, that 10-year period was great because we didn't lose any money for our index annuity clients in 2000, 2003. We didn't lose any in 08. And We'll talk about Mark Skousen and some of our other clients that did that. Another huge thing, which I'm going to get into right now, is the sequence of return. A lot of people have not even heard about this risk in retirement, but it's one of the biggest risks in retirement. And I'm going to give you an example of two siblings. So we've got Bill and Jill. They both have $1 million. Bill is going to retire in 1996, and Jill's going to retire in 1999, each with $1 million. And their plan is they need $40,000 a year out of this million, and we're going to have a 3% inflation factor. So let's look at the difference of what happened just based on the time that they retired. So Bill, he had some great run up. He had the nice bull market, 96, 2000. His retirement really grew and took off. Whereas Jill retired right at the worst time, into 99, and the market tanked in 2000, and she's still pulling out her money. Look at the difference, it's huge. $1.9 million difference by the end. Jill barely made it. She barely has any money left, only taking $40,000 out just because of poor timing. And so the question is, when you're retiring, are we retiring in 95 or are we retiring in a 2000? Are we at the top and going down? We don't know. And so the index annuity is fantastic at eliminating this sequence of return risk because you can't take a loss. It's when you take a loss in the beginning that you get creamed. Mm-hmm. We have to avoid those losses. So if you're stuck...
So Bill and Jill were in the market then?
They were in the market, yeah. They were in the market. But if you're dabbling, you're playing around in cryptos, and I mean, we have clients that are 100% invested in equities, and they're 85 years old. And because bonds have been so low, the interest rates have been so low, they had no choice. But you can get creamed, set yourself up. I mean, I guess if you're at 85, it's okay because you've already made you know where you're sitting. But it's these guys that are 70, 75, 65, taking huge losses right in the beginning. They're going to be like Jill.
An 85-year-old can live 15 years pretty easy.
Yeah, I mean, So we want to avoid those losses and the sequence of return, and that's what the index annuity is going to do. And I'm going to just show an example here of an indexed annuity. I took one that actually is available today there's so many, I said there's over 40 different indexes that we can track. Just to make it a little simpler, it's hard to make these simple, that's why I had to write a book. But
you do have to write a book.
I do. I picked one with just the S&P 500, just to compare the S&P 500 with a 45% participation. So if the S&P 500 is up 10%, we're going to make 4.5 on the good year, and on the down year, we're going to make 0. And I'm going to compare that just to the S&P itself. Now, there's a lot of other ways to compare it, but this is a good way to just simplicity. And I'm just starting in 2000. So 2000, obviously, the S&P had a rough start because you had the bear market, the tech wreck. We lost a lot of value. And if we're not taking withdrawals and just letting it grow, the S&P did so fantastic by itself the last decade that you ended up beating the index annuity. The index annuity was well in the lead in the beginning because we didn't take any losses. But by the end, the S&P ended up winning. It's at 4.9 million versus 3.3 million over that 21-year period. So great, stocks are fantastic. The problem is what happens if we take that same idea and we're going to start taking withdrawals? Same scenario. Only we're going to take 6%. This time we're not going to do inflation. We're just going to take 6%. So we're taking 60,000 out a year. And it's interesting that the S&P by 2016, if you had their $1 million, you ran out of money. And isn't that crazy? You're taking 60,000 out. Whereas the index annuity with 45% participation, not taking any losses, still has 506,000 left. Significant amount more. 0 is your hero. Not taking those losses is huge. Now, I'm not saying to put all your money in these, but I'm saying to put a chunk. At least put on the side, or get the MYGA, or get the SPIA, something that's absolutely safe.
Well, I like what Mark said in his newsletter recently.
I'm going to go to that slide.
Where he says to take some chips off the table, because they have the Freedom Fest in Vegas every July. So, except for last year, it was in South Dakota, which was awesome. But they, take some chips off the table because, you can't have it. You can't always be at risk. At some point in time, you have to to mitigate that risk, or you're gonna take a hit.
Yeah.
You're always going to take a hit at some point.
Right. Yeah, Mark had amazing timing, just thinking, and now we have 2020 hindsight, but he came to us in '07 and said, hey, I want you to move my wife Joanne's money into your best indexed annuities. What do you have? And she got in '07, and market, we all know what happened in '08, totally tanked. She didn't lose a dime, and then was able to ride the rebound up and doubled her money by 2020. What's even crazier is that in 2020, she cashed out of the index annuity because her surrender was over and got back in the market. Right. So she had really amazing timing.
Had the write-up.
Had the nice write-up. Mark actually came to me in November. We did another webcast with just Mark and Roger Mikowski in November of 2020 this year.
Now, that's on our website?
That's on our website, and they can watch that, where we get more into the index annuities and why. But yeah, he said, hey, let's talk about these index annuities again, because I could see it be important. And look where we are. We're down 11% on the S&P. So these guys have a good feel for what's going on. And may not be right 100% of the time, but they get it. They read the tea leaves. So I want to give an example of an index annuity right now that's available. And again, there's over 2,000 that you can choose. That's my job. I have fantastic software that I can see every index annuity on the market, and I can evaluate if you have an old annuity that you want me to evaluate the different index strategies, how to invest. I'm happy to take a look, and then I'm also happy to make recommendations. If you've received something from an advisor, you think maybe this sounds too good to be true, or you just don't understand it, I'll be happy to try to break it down for you. This right here is a great example of one. This is a company that's been around over 100 years, A+ rated. They've got some really nice indexes that are well diversified. They're not just S&P. I don't want to be just S&P right now. I want other asset classes. They got this one that has gold, equities, bonds. There's a lot of different indices now that we can use and we can track. No cap, that's the other thing, is if you have a cap, make sure you understand what that cap is. If you're getting a cap on the S&P, you want at least 5.5% today. That used to be 3. A couple years ago, the best we would see is 3. Now you usually at least get 5.5 on the cap of your S&P. But a lot of these other indexes will give you no cap, and they're going to give you higher participation rates. Sometimes you can buy an even better one with a fee. Like in this example, with the 1% fee, they'll give you 145% participation. So if it's up 10, you make 14.5. Some years we've had clients making 15, 20% on these indices, and I'll be happy to show some back testing and how that works. This is only a 5-year commitment. All the interest you make each year is banked. So if I put in 100,000 and I make 10%, or my interest earned is 10%, I'm now at 110,000, that's banked, and that's mine. And the next year, if it loses 20, 30, 40%, I'm still locked in at that 110. And if it rebounds again and it makes another 10%, I'm up on that 110. I don't start from down below. So it's always wiped and washed clean. That annual reset feature is the single most important part of the index annuity, is the annual reset. This is a 5-year, so only a 5-year commitment, 10% free withdrawals during the 5 years. And if you want, you can move it to a fixed rate if you just want to sit on the sidelines. I had a client I talked to today, we had an annual review, and they said, you know what, I don't even want to be in the index this year, just give me the fixed. Give me the 2.4, I think they were 2.5, moved into that fixed rate. So we can always do that. And we can divvy up into the different indices. You can do percentage. We can do 10% here, 20% there. And that's another thing, is I'll help advise where to do those allocations. But yeah, there's definitely some really good 5 years now.
I think the key to the overall concept of the indexed annuity is that you get to participate in the upside, but not in the downside. And when you do have an upside, you lock it in and can never lose it. I think that's the easiest way to understand it. And so that's why Mark and Eifrig and the group, Carlson, they all recommend that we put money into these because it's a safe harbor, but it also has upside.
It also has some decent upside. So it's a nice inflation hedge. If those indices do well and if there is inflation, then those indexes should rise. Obviously, there's a lot of indexes. There's real estate indexes. There's gold. There's S&P, variations of the S&P, the Dow. And these insurance companies are very creative on these indices, and it's starting to get maybe a little too complicated, but I will try to break it down. We have some excellent software to try to break down and show you, and I'm looking at these every day, which ones are the best and are poised to give you the best return. I'm saying 5-7%, somewhere around there is what we'd like, what we expect. Of course, we have no idea what the future is going to be, what we're actually going to get, and what indices are going to do well. I try to make them diverse allocations, different indexes. One of the things you brought up was the big bonus. Maybe talk about that a little bit.
Well, the other day I'm driving home and I hear this guy come on the radio, and I don't know what the other markets are, but in the Phoenix market here, we have a pretty big market. I mean, and we have a lot of retirees, especially here this time of the year. Although once it starts to get up triple digits, they leave. But we have a lot of folks here, and I don't know. It seems to me that these guys are feeding off of their the greed, I guess. Because they're pitching. This is what they pitch on the radio, Todd. It was a 10% guarantee. Okay, guarantee. 20% upfront bonus. Who's not going to want that? If I have $100,000, I'm guaranteed 10% a year. Plus I'm guaranteed 10% a year on $120,000. I mean, who's not going to want that? And I'm scratching my head. I'm going, how in the world can KTAR, our #1 radio station that is owned by the Bonneville Corporation, you know what that means, and how they let this, it can't be true. Not in a market where you can get your CDs are paying 1%.
Right.
I mean, I just don't know how they can allow that kind of advertisement. So tell me what's going on here.
I have clients come to me all the time saying, this other advisor is giving me a 30% bonus.
30%.
30%. And I'm going to show an example of the 30. It's giving me a 30% bonus and then 10% every year after that.
Yeah, well, that's kind of the same.
And okay, so what are the insurance companies investing in? They're about 70% in bonds.
Right.
And they might have some vineyards or some, timber.
Timber, yeah.
And bond. And some hedge funds or whatever. They're hedging. Hopefully not too many derivatives. But they're diverse, but they're not making 30%. So how could they possibly give you 30? So what is the catch? And the catchphrase when you listen to those radio ads is on your retirement dollars. That's what they'll say. So that's kind of misleading because you think that's your money.
They don't really say that because at the end of the ad it goes, so you don't know what they're really saying. Yeah. I have no idea.
And we have never, we've had these bonus things since we first started. It came really in 2000 is when I think it really got big. And then in 2003, after the recession, they started coming out more and more. They started getting these income riders that people started selling that instead of just the actual what are we getting. And I think you have to understand the difference between your walkaway dollars and then your retirement income value. So if we look at this example here, I ran one, and this was actually a very competitive example that we're going to look at. This was one of the very best, and it's not bad. I have $1 million, so we're starting, and we have a 30% bonus. So our income base, our $1 million, if we look at our income base, it's going to show on our statement, is worth $1.3 million right from the start. So that's a 30% bonus. But we need to understand what our actual money is. Our actual walkaway money, if we were to get this and then say, hey, I want out, would be $908,000. That's our real walkaway money. Now, when we were talking about the regular index annuities before, we were talking about walkaway money, regular money. Now, there's a surrender charge, but the actual, but that when we're ratcheting up, we're going 100, it's going to 120, 130. That's walkaway money. That's not strings attached that we have to wait. Another one that just had a huge bonus, they can't take the money for 10 years. Now, something interesting, I was talking to an insurance actuary, and he was telling me that the longer they make people hold the money, the better it is for them. because they can captivate and they know, and then there's going to be a lot of people that are not going to make it, they're going to die. And so they're not paying out. So the longer you defer and you wait, the better it is for them. So I have a lot of clients who are like, oh, I'm just going to keep deferring. It's going to keep growing at this 10%. Well, you're never going to actually get your money. And they just held it all your life. You have to get to the money. And that's where the IRR is so
Okay, question though, at death, what do the beneficiaries get then? If you're holding it and you're not taking it, you're waiting for
well, that's the thing too, is if we have the income rider, we're typically sacrificing something else, because usually they come at a 1% to 2% fee,
right.
And you also don't have as much upside growth. Like that example I said where we had 145% participation, you might have the same version but that has the income rider that's only going to have maybe 60% or 70% participation. So we have less growth. That means less death benefit. And really the only way you're going to win is if you live a long time. But then the argument is, well, why didn't I just get a DIA? Delayed income, a deferred income annuity. Why didn't I just get that? Now, the advantage, and I'll tell you the advantage, is this has liquidity. The DIA, you're committed. But you can get an index annuity that's very competitive.
Yeah, but you can't get an index annuity with all these bonuses and that has liquidity.
It has some liquidity.
10% liquidity maybe, but or whatever, but you can't bail on the thing.
It will have. Yeah, it's designed to run out of money by the age of 85. So just these high payout income annuities, if you run an illustration, even under definitely on the guaranteed scenario, but on the hypothetical, it should be getting down to zero around mortality, which is around 85. So you'll start to see that it goes to your account value goes to zero, which is also your death benefit around 85. But if you outlive it and you live to 105, it's a good deal. All right. And just to compare, I ran this one. It was very competitive. It gave us 1.3 million, and then it increased 10% every year. So by the time we started the income at age 70, or the beginning of the fifth year, we were getting 81,000 a year for life. And that's really close to our DIA. It's almost identical. So they're very competitive. And then the advantage here is, I do have liquidity and I could take this money. So I would probably argue that this is a better deal than the DIAs right now. Sometimes just the way they price, we have to see. But the DIA, I'm locking up my money. I don't have access to it. This, I do have some access. And that is guaranteed. That the 81,000 is guaranteed. But really, I mean, I'm not getting my money back, my million back, until I'm 81 years old, till year 16. So I did have to wait 16 years before I got my million back.
So a 55-year-old would be tough on them, wouldn't it?
It's not going to be as high of a payout. But the same scenario where the longer I wait, the DIAs and these income riders with the income benefits, they're going to be quite similar. It's interesting how close they're priced. But I just want to make sure that dispel the myth that you're not getting a 30% bonus. You're getting a benefit to your income base that you can then draw from. It's very confusing, but nobody's getting 30% bonuses on walkaway money. That's not happening.
Yeah, I was at a conference, a money show conference not too long ago, and one of the guys that I was meeting with said, "No, I'm getting 10% on
it happens
annuity."
All the time, constantly.
Yeah, and I said, "No, you're not on your walk away." And no, I'm getting 10%, and it was getting heated, and I had to back off and and just because you didn't want that. I didn't want that kind of a confrontation at that particular setting, and it's almost as if it's Notre Dame or versus USC or one of these rivalries. It's they really take a side. It's a passion, and unfortunately they've been. I don't know if the word lied to. That might be a little strong, but certainly not told the whole truth and nothing but the truth.
Right.
So.
Yeah. Let's go back to the DIA. And so if I did a life-only DIA, that's why I did it, and our example was $87,955, so about $88,000. Now, in that scenario though,
That was a 65.
that was my 65-year-old waiting till 70, and it's going to be the same throughout. It's going to be similar numbers, your age. But I'm taking the risk of my longevity, so I should get more. And that guy did get 88,000, so I got a little bit more. But if we said return of premium, which is going to make it similar to this indexed annuity with the income rider, because I still have that asset, right? I still have the access to it. That's going to be very similar to the return of premium. And that's 81,600 versus 81,820 for the DIA. So it's very close. They're very similar. At 85, the IRR is not 30%. It's 2%. So if I lived at 85 and I get this thing, my rate of return on investment was 2%. That's how the insurance company is able to do it, because they know that not everyone's going to live to Methuselah, age of 100. I guess the key is just to have reasonable expectations, and I like to call. I personally I like the index annuity with the income riders if they understand what it's doing. But in general, I like just a simple index annuity without the rider. I feel like getting both is like belt and suspenders. And the belt.
But what about the bonus? Can I get the bonus? I like a bonus.
You can get bonuses on just the plain index annuities, but you're still going to give up something. You're going to either give up participation rate in the long run. Generally, the bonuses will take something. We've seen some deals where the bonuses were just amazing. But generally now, with rates where they are, there's a big good give and take.
I think probably a word to the wise, you never get anything for nothing.
Right.
You
just got to be reasonable. What am I really? You just think about it.
What's the trade-off?
The other trade-off on what we've been talking about, the DIAs, the SPIAs, and the income annuity that we just showed with the rider, that was the 81,000 payout for life, but there was no increase. So that's still that same. It's not an inflation hedge.
Right.
They do have some index annuities with income riders that do have inflation hedges, and so you're going to get a lower guarantee payment, but it's going to increase based on the performance of the index. So I'll give an example here. So one I just pulled today was getting 49,000 on the worst case scenario. So versus the 81,000, big trade-off to start. But by the end, when they were 95, it was 370,000.
Whoa.
Yeah, so huge difference. I like maybe getting a combination of the two. Maybe you get one that says guaranteed, I want the higher, and then the other one, I get a little increase. Maybe you split the money up in different carriers.
Here's a key question though. Is my money in the annuity going to be qualified money in my IRA and 401k, or is it going to be outside? Is it going to be after-tax money? What do you recommend? I mean, because I know that right now it's about 60% is in qualified accounts.
Qualified? We see a lot of qualified, and that's fine. Definitely you can do the qualified. So that's where the majority, and I don't mind being conservative with the qualified because we don't want to pay tax on that money, and these aren't designed to make it rich. Right. So we're talking 10% returns.
Yeah, and I think where we're seeing the money roll in from the qualified, from the IRAs and 401ks, is people really don't have a whole lot of choice as far as safe money is concerned.
Right.
And it's the safe money.
The safe money. But we do see a lot of regular after-tax money. Yeah. And that's great too, because it's not fully taxable like the IRAs. You just pay tax on the gain. Here's an example. I ran this graph here of the static level income, which was the 81,000, and then the other one that grew to 370. So if you're going to live a long time and you're thinking we're going to have inflation, you probably would lean more towards the one that's going to increase. You get a lot higher income overall. But again, maybe a combination of the two is good. Next annuity, we're going to briefly talk about this, is the registered index-linked annuity. And we don't even offer these anymore. We have a partner that does. And usually Keith is the one that we would recommend. But again, so there's a little more risk here. The index annuities have no risk because there's zero floor. This is you're gonna either take a buffer, maybe you'll take a 10% buffer for the first loss. So they say if it loses 10%, you're gonna eat that first 10% loss. But we'll give you, maybe instead of 100% participation, we'll give you 150. We'll give you more participation, more upside, but you're gonna eat some of the downside. Or they'll say, if it's more than a 10% loss, you take anything lower than that. There's different ways they can construct it. I think it's a little bit confusing. I mean, the index annuities are confusing, but this one now we're taking losses and it just kind of changes the game. I'm just thinking, well, maybe we just do stocks or something else to hedge what we're trying to do. And then variable annuities, similar to the linked in annuities. The variable annuity, you're going to have sub-accounts that you can pick. So you can large cap, value, any fund you want, you can get. We have one that has 400 different accounts that you can look at or that you can choose from. And they're typically going to come with a little more fees than just a regular account, a regular brokerage account. Where I see variable annuities value is for people that want some kind of guarantee. So you can add a rider to it. Those riders are going to be, typically by the time you add all the fees in a variable annuity, you're going to be around 4%. But a lot of times you get what you pay for. We've had clients that had variable annuities and they've had significant growth over this last decade. And they've doubled, tripled, they've been better than any of our other annuities.
But you have to stay awake with a variable annuity.
You got to pay attention.
Yeah.
Now you got these income riders and you can be guaranteed. There's a lot of bells and whistles to those. You can add death benefits. You can add death benefits on the index annuities too. There's one that's really awesome. I don't have time to cover, but
well, let me ask you this: you kind of been bred on, you've been fed the milk, and so you understand index annuities and annuities in general. Fisher says that. And there's a couple of others that they say that annuities are the worst possible thing that you could do because of the fees. But are there fees with indexed annuities? Is there an upfront? Am I putting in $100,000 and you take $5,000 from me?
So that's interesting. Yeah. So they can be, if you don't get the riders, and you can get them with the riders without. There is no fee. So definitely the 5-year, 10-year, we can get just the naked index annuity and there is no fee. So the fee is that maybe we're getting less participation in the index or less growth than we could have elsewhere. So maybe you could say, well, we're getting 70% participation in the S&P and it went up 10%. We're getting 7% because we got 70% of it. That's a 3% less than if we would have been just in the index itself.
Yeah,
so
but you don't have any loss though.
I didn't take any loss, and that's the trade-off. You can definitely look at your statement on an index annuity, and I've got one with Lincoln, I've got one with Midland. We got over 60 carriers, but I'm thinking of the 5-year that there's no loss.
And nothing taken off.
Nothing taken off.
No.
And you're getting good upside. I mean, it's a really good opportunity.
Yeah. Okay. I get.
And we can get into the fees, but yeah, do you think generally when people are talking about the fees, they're talking about variable annuities? I know Fisher, that's what he's thinking of. I don't think he understands index annuities. From what I've read in the articles.
Well, we were on the design committee of one of the very first index annuities in the 90s, and that they still don't get it, and that's how many years has that been?
Kind of get myopic on what their what their agenda is.
Yeah.
But we've made terrific returns for our clients over the years. And it's
yes,
been
we have,
one of our most
without
successful.
risk.
Without risk.
In fact, we even created an annuity called the Sleep Well at Night annuity.
Yeah.
So
good old days.
Yeah, it was good.
So why don't you take us on the last one, the hybrid annuity?
Yeah, so just real briefly, let me talk about the hybrid annuity. So the long-term care annuity. Basically what it is you take a single sum of money, in this case, let's say $100,000, and you give it to an insurance company. Immediately, day one, you have 3 times what you put in for long-term care. So your $100,000 becomes $300,000 for care. And this is the plan that IFRIG has really been hot on for a long time. as the plan continues through the years, it earns some interest. Not much, but some interest, and then it's always 3 times whatever the annuity value is. If you never have a claim, which is everybody's goal, the value of the annuity is returned to your beneficiaries. If you have a claim, your claim is off the 3 times what you put in. If you and if you decide to bail on the plan after sometimes 10 years in some of the cases, you get all of your money back. So there's a return of premium on it. There's some iterations on this now. There's we call the true return of premium long-term care. And there's a report that we have. It's on the website. You can go get it. It's called Leverage Care Solutions Report, and it explains the 3 new strategies that have been implemented by insurance companies to help fund your long-term care. We've found that long-term care events are the major financial exposure. It's the most major financial exposure that our clients have. Even more so than the market.
I would say that of all the things that we offer, all the investment vehicles, we get more thanks letters from people for the long-term care hybrids.
Well, because we've had claims.
Yeah, we've had claims.
We've had claims, and we've had clients that have, and it's a sad event. There's no question about it. No one wants to go down that road, but right now, 80% of women over 65 will go down that road,
right?
For 90 days or more. Men, not so much, 65%, but overall it's about 70%. So it's an eventuality, and it's a good thing to pre-fund, to put the money aside, to set aside. I mean, it's the option would be to set aside the money and put it in a coffee can in the backyard. Tell the kids to go get the money if you lose your marbles. You can't do 2 of the 6 activities of daily living, or you're cognitively impaired, and go get the money. And your daughter says, well, wait. I just heard David and Todd talk on their podcast that if we put it into an insurance plan, it's worth 3 times instead of just the $1 that it would be in the coffee can. Okay. Yeah. So anyway, there's some really good iterations on that that we can run some examples for them, show them the different options. But the first thing I would do is get the special report through the website.
Get the special report.
Yeah.
The power play that we've seen is some clients, maybe they've had some growth on their variable annuities, the market's been up, or indexed annuities, or fixed annuities, and they've got some gain. They use regular after-tax dollars, not qualified money, not IRA money, but they've had some growth, and they've maybe started with 100,000 and now it's 200,000. Well, if you try to take that money out, it's taxable. Yeah. If you just take it out.
First dollar. Until you get down to that basis, you're going to pay tax on that as ordinary income. But thanks to 2006 Pension Protection Act, Bush put into play, it finally came law in 2010. You can now 1035 exchange that annuity with all the gain and make it into one of these LTC combo annuities and get that money out tax-free. So say I had that 100,000, grew to 200,000, that's all gain. I can then buy 600,000 immediately of long-term care that I can share with my wife, with husband and wife, couples, can share in that value, in that 600,000 pool of care, and any money they take out is tax-free. I mean, that's a huge power play. Any money that comes out for care.
If you know anyone or anyone that has a growth
so
on annuity.
You're taking tax-free appreciation or tax-deferred appreciation and creating tax-free dollars.
Right. Yeah, that's an amazing play.
That was a good law.
One of the very few wins where we have that we can actually get to it. Not a use it or lose it proposition. You still have that 200,000. You still have that death benefit, your money that grew, your money that you started with. So yeah, there's a lot of different ideas. The biggest thing I've seen when we talk to our clients is there's so many different variables and things that they can get that a lot of times we need to just analyze their retirement situation, because everyone's different. And a lot of people there's a lot of similarities, but they've all got little differences. Some have children they want to leave it to, some don't. Some have a huge IRA, some have no IRAs. There's just a broad spectrum, and we've seen it all. And so the biggest thing is just for to talk with us, and we'll run an analysis. Maybe go ahead and explain.
I think let me just kind of emphasize that. So one of the things that your side of the office, or your side of our firm, can do is you can run a comprehensive financial analysis to allow them to see, if they're going to run out of money, what the advantages of Roth conversions are versus non-Roth. And you can do a comprehensive
long-term care.
Yeah, you can throw everything into the mix and allow them to see. It's retirement analysis. It's $497. That you charge for the analysis. It's well worth it. It's certainly very costly from a time perspective, but it also allows us to really get personal with the individual, and we become one. We become one with you, and I know you do. You invest so much time and energy into those folks, and it's well worth it to have an expert like you that's been in the safe money world forever to look at this and look at their estate and look at their finances and determine, okay, how do I get from here to here and without running out of money?
Right.
If you have the means, you don't really ever want to run out of money. We were talking with a client the other day, you and I were actually, and they're worth about $20 million. And you know what their number one concern was?
Yeah, it's still the same.
It was running out of money. And I'm going, how in the world are you going to run out of money with $20 million? And unless you're spending $1 million a year, and they weren't. They were pretty austere. So anyway, it's.
We have the estate analysis for those guys too.
Well, yeah, for those that have large estates, that when I say large, over $6 million, get your estate analyzed, and that's my side of the company, and we'll analyze your estate from top to bottom, determine what moves you can make to guarantee that your kids don't have to pay taxes out of your estate. You let somebody else pay the taxes, and B, that you guarantee an inheritance to your family, and you keep the money in the family, keep your wealth in the family instead of giving it to the IRS. They can go onto the website, get the book, the special report, Disinherit the IRS, or the Bombshell Battle Plan. Both of those are available through the website. So the website is
EPMEZ.com.
Yeah, it's pretty easy. EPMEZ.com. EstatePlanningMadeEasy.com. So
go there, and then you can hit the annuity section, and that'll give you the annuity options. You can order the report. You can request. The biggest thing I would think is just fill out the analysis request. But you can request if I had $1 million report that I wrote. And then also there's still the book, The Future Retirement Savings. It's 2014 edition, so
but it still gives you the basics.
Yeah, give you the nice basics.
And let me just emphasize one last thing on my end. Call Todd. This is as you can see, he knows what he's talking about. Yes, he is my kid, and I'm proud of him. But regardless, I know that I didn't tell Mark to recommend you.
Right.
I didn't tell Carlson to recommend you. Now, yes, they recommend me as well, and so maybe it's in the family. Certainly didn't tell Eifrig to recommend you. Now, Tony Sagami's been recommending you since day one.
Right.
So, these are guys that are the experts of all fields of investments.
Yeah.
And they turn to you as the information source for annuities.
Right. Yeah.
And what I recommend that you do today, viewers that are here viewing with us, is go to the website, EPMEZ.com, and order information about the annuity. Go into the annuity side and get the information there, or the estate analysis, But one thing that I would do is give us a call at 888-892-1102 and ask to talk to Todd straight up. Okay, thanks. Have a wonderful day. Take care. Bye.